We'll now have Samir Murji come and talk to us about how to maximize value, how to prepare for value drivers from a legal perspective to take advanced actions. Samir is an associate with Fasken, our host today here, the business law section. He's engaged in broad corporate commercial practice. He's been involved in a variety of transactions, including mergers and acquisitions, debt and equity financing, and initial public offerings. He won Reuben Wells Leonard Prize in Corporate Finance in 2009. He is Queen's Law Society Millennium Award in 2009. He's a member of Law Society of Upper Canada and Canadian Bar Association, and member at Ontario Bar Association. Please help me welcome Samir to give his presentation.
Sort of what value drivers are. And value drivers are operating and organizational factors that have significant value impact that are controllable by the management team and the founders of the business. And this was already touched on before, but to maximize enterprise value, it's best to develop a set of best practices to incorporate in your business from the start of your business. So I'm going to speak on corporate organization and governance to start off with, how you should set your company up from a legal perspective, securities law issues that could come about throughout the course of your business to your exit, intellectual property and how that could impact value, increase value, employment law considerations, and if there's time, tax considerations. So corporations are governed by corporate legislation. Generally, they'll either be federally incorporated or incorporated under the applicable province of incorporation. So there's also constituting documents, which are your articles and bylaws, which you should set up from when you start your corporation. And directors are responsible for the supervision and management of the company, whereas executive officers are more responsible for the day-to-day. Although the corporation provides liability protection, there are fiduciary responsibilities on officers and directors, which we can discuss. So every director and officer of a corporation in exercising their powers and discharging their duties shall act honestly and in good faith, and they must exercise care and diligence and the skill of a reasonably prudent person. So that's a reasonable standard test, which is used in multiple jurisdictions in law. So this is the legal standard of this reasonable prudent person that directors will be held to. So the duty of care has both, as you can see from the previous definition, has both a subjective and objective component. The director and officer has to act as a reasonably prudent person and is expected to fulfill their corporate obligations in this regard. Now, this is not only the legal requirement, but you can imagine if you were to behave in this manner, the mantra throughout your corporation would be to maximize value, maximize shareholder value, because you'd be acting, all of your business decisions would be in the best interest of the corporation, not in yourself individually. So now we're going to discuss shareholder agreements. So although there's no legal requirement to have a shareholder agreement, it is very important in the foundation of your company and how shareholders interact with one another on a business level, and what rights and obligations they have within the corporation and in terms of the capital structure. So a unanimous shareholders agreement can also be used to restrict the powers of directors. And this could be done for a number of reasons, where it could be done to, in essence, what it would mean is that there would be a requirement for a greater number of votes for directors to proceed with certain actions of the company. It could limit the director's discretion to issue shares, make an amend and repeal bylaws, appoint officers, fix remuneration, borrow money, and instead put that decision-making back into the hands of shareholders. So the common terms of shareholders agreement is the procedural matters. So, the frequency of the board meetings, procedure for election, quorum of meetings, and the covenants of the corporation. So again, the insurance, preparation of financial statements, restrictions on share purchases, transfers, and sales. Preemptive rights. So basically, the way preemptive rights would work is that, if you want to prevent the dilution that you have as a shareholder, a preemptive right clause would be entered into a shareholders agreement, which would allow you to, purchase shares and participate in future offerings of share issuances. A right of first refusal is also there for the purpose of, if there's 3 shareholders in a company and one shareholder wants to exit that company, they have to offer that right of their shares to the other two shareholders before exercising it and selling it to a third party. And so that sort of protects the company and keeps it between the founders who started the company. Piggyback rights, there's that. So if someone comes around and wants to buy my shares and not the shares of my partners, I can't just go and sell off to them and head over to Bermuda. I gotta wait, and I have to bring my other shareholders on board as well. And drag-along rights is also a similar provision where so again you want to sell together, and if someone has made a purchase to offer, you have to a majority shareholder. You don't want to leave your minority shareholder in the company. You want to bring that person along with you. So to drive value, it's important to have a clean shareholder composition and management. Having too many shareholders with divergent interests will concern investors. And so also voting trusts are important as well, because what voting trusts will do is, it'll create voting power, put voting power in the hands of one shareholder, and it will create a unified vote. If, for example, investors are to come in and shareholders want to approve a certain investor coming in, that decision can be made by one shareholder when there's a voting trust put into place. Again, clean and simple share structure, not too many, with limited numbers of class of shares and stock option grants, manageable number of shareholders, implementation of a stock option plan, no obstacles to obtaining shareholder approval for the issuance of new shares to investors. That's very important, because you don't want to be in a situation where one shareholder is not allowing you to accept investment or to issue shares to a potential investor. So you also want to minimize dilution, and that in the sense of pre-existing options, warrants, conversion rights. You want to also create, it's important to create the ability to accelerate your vesting options and warrants. There might be investors who want to come in, but you have a bunch of options that they want you to accelerate or don't want there to be there after their investment has kicked in. So it's important to have acceleration provisions put into place. Again, you want to limit shareholder vetoes, which can be a section inserted into your shareholder agreement, which allows shareholders to veto certain transactions or not want to accept certain investors into the company. Right, and it can also affect control, because some investors are coming in and they're looking for some sort of control in the business, and if you have a lot of control in the hands of the shareholders in the sense of them being able to veto certain aspects of it, that could also be a potential issue for shareholders sorry, for investors. So you want to, another issue, it all comes down again to control, is secured debt obligation. So it's important to limit secured debt obligations because prior secured debt will have implications on the business and will restrict what a business can do to a certain extent. Shareholder loans can also present unique problems because they can be perceived conflicts of interest, because now you're a shareholder and you're a debt provider, and at the same time you also have to comply with your fiduciary duties, because often shareholders in early stage companies are also directors and officers. So there's multiple conflicts of interest at play there. So you want to also avoid built-in liquidation bombs. These are concerns raised for investors by shareholder puts, third-party debt, maturities, pre-existing, priority liquidation rights, shareholder exit plans, and triggers in material contracts. All these things result in money leaving the company before the investor can get their liquidation. So they might, when they see these types of things when they're doing due diligence, they might avoid the investment altogether. That's the point right there. So it's kind of a wild card, and it's hard to determine what part of the pie will be left for the investors when they liquidate their interest. So you also want to, this will also develop value in the business prior to exiting, ensuring that the management is adequately incentivized and engaged. And the way you do this is, and investors do want to see the management team getting paid and having some reward and upside with the business. And that's done through, employment agreements with cash and bonus structures built in, equity, stock options, and other benefits as well. You also want to have, at an early stage, adopt a culture of transparency. And this can be, from the startup level, this can be as easy as, including your management team on emails where, large business decisions are being made, and just showing that transparency among your management team. And that creates a culture of transparency. Also, cash contributions and historic reinvestment of routine earnings. This looks good from an investor perspective too, because you want investors to come and put in money in your business, and the fact that the management team is reinvesting some of their bonuses or their cash into the business looks good on the business as well, and looks good on the leadership of that and the management of that business, and it sort of creates confidence in the investor that I'm going to put money in, knowing that the management and founding team has also put in money in the business. So this isn't really a legal point, but just research your market, know your market, share market value, competitive advantage, and diverse customer base translate into cash flows and enterprise value. It's good to update your business plan with changing market conditions, new products, competitors, new features of your business, and new business segments. And then there's a point there that talks about the executive summary of your business plan. This is by far the most important part of your business plan. It should almost be a separate document altogether. There's different articles out there that say it should be part of your business plan, but it's kind of good to have it as a separate piece, because investors will typically see a number of business plans, and it's just a very easy snapshot of your business. I know it was already mentioned that it can be in the form of an Excel spreadsheet, but typically it's a couple pages, and it gives you the information you need to know quickly. So, on this point, it's very easy as a startup to think of your own personal goodwill as the goodwill of your company. And in the beginning, it sort of is that way, but it's you should always think of it as the reputation of your company and building your company's brand. And you know, and that's in your name, your trademark, your reputation. And so if you develop that and keep that in mind from the initial stages, it'll help you develop that corporate goodwill as opposed to personal goodwill. Okay, so due diligence was maybe a single point on the last presentation, but I got a couple of slides on it. This is typically what lawyers will help with, and it's really true that you should be thinking about a merger, sale, or IPO from the get-go. And you know, each of these activities, you know, seem like the holy grail for startups, and you know, that's the end point or the exit. But there is a great deal of documentary and financial due diligence that occurs at this stage, and it will take over your life at that moment in time, and you know, you'll just be dealing with this for most of the time instead of working on your businesses. Sure. And due diligence will typically uncover many of the issues that I've already discussed, and I will discuss later on in the presentation. And so it's important to have all your ducks in a row from the get-go, and you know, keep all of your corporate documents, foundation documents, board minutes, employment contracts, customer contracts, all organized. And a good way, I think, that I've seen some of my clients, the mechanisms that they're using are, you know, uses of electronic data rooms, but sometimes a data room might only be available during the period of, you know, one of these activities. So it'd be good to use Dropbox, Google Drive, or Box, or something like that, and just keep track of all your legal documents, and not just store them. Keep a nice index, knowing where each thing is, and having an idea of how to find it, so that when investors come in, boom, you can just give it right to them, and they have it all ready to go. And even, you know, as far as your originals go, keep your originals in a safe place, and that you know where they are. And it's good to get in the practice of doing this early on. So securities law issues. So these do, you know, impose constraints on your ability to raise money for your startup. You know, and the law is no person or company shall trade in security if the trade would be a distribution unless a preliminary prospectus and final prospectus has been filed and receipts have been issued. So, you know, when you're doing an IPO, you would need a prospectus to be filed, and the prospectus would be, you know, a very large document that is basically your, you know, what you're telling investors, what they're investing in your business. But however, there is exemptions to the prospectus requirement, because you know, not every company is in the position to draft a prospectus or go for an IPO where they need a prospectus. So the exemptions would be an exempt offering or a private placement. So private placements are exempt from these prospectus requirements, and you know, the purpose of a prospectus is to protect the public as investors. So private placements typically are used for investors that don't need those same protections. And so there are some resale rules and first trade restrictions that apply to those shares in the non-equity in private placements, in that, you know, you may be able to resell it or trade it, but it would have to be under certain restrictions, not to the general public. So it puts you in somewhat of a bit of a bubble, a closed system, because the securities aren't free trading as if they would be in the public market. So some of the exemptions that can be relied upon are the accredited investor exemption. So, you know, investors with financial assets of $1 million or income over $200,000. And that's not just for their current year, it also includes their past year's income. Or if, you know, an individual and their spouse would be, the threshold would be $300,000. And then there's also a private issuer exemption, where you're a private company and you issue up to only 50 investors. There's some other restrictions that go along with that, which I'm not going to go into too much detail on. And then, you know, founder, control person, family exemption, which is applicable in Ontario. And then where the investment is under $150,000. So typically the most common private placement exemption that we deal with is the accredited investor exemption. IPO. Okay, so, you know, in comparison, an IPO has a lot more work and is a lot more costly to go through. So first of all, you have to meet the financial requirements, which were sort of touched on in the previous presentation. So those financial requirements must first be met. And then you must comply with all securities requirements, and you'll need the help of a highly skilled corporate lawyer, which I can give you my card afterwards for. But you also will need the right management team in place, and it should be a management team that has considerable financial accounting experience with disclosure and accounting and legal requirements as well. There will also be a requirement to have independent directors on the board, and again, can't stress how much more the disclosure regime is, how much more is required of management in terms of the disclosure regime for public companies as opposed to private companies. Right, and then there's also, you go through the whole process of drafting the prospectus, and then there's a period of time where the regulators review that prospectus and then send back any comments that they have or any questions. And then at that point, you would also be conducting your investor roadshows, where the corporate management team would go out to investors and seek investment on an IPO. So employment contracts. These also this is an area that investors will also look at when conducting due diligence. They'll want to make sure that you have your management team and your key personnel locked down. Things like they want to also make sure that if you have some IP, there's assignment of IP clauses in there, which we'll sort of touch upon, and they just want to make sure there's no strange payout or termination clauses, even change of control clauses that will trigger large sums of payments to certain key employees. So there's sort of three methods of employment contracts. So there's the complex legalistic contract, and then there's a more informal methods that can sort of be employed depending on the situation, as every situation is different. Some of the common employment contract clauses I'm not going to go into too much detail on. It's quite legalistic. So you want to ensure enforceability. This is really important. It seems it's sort of intuitive once you think about it, but to get something, you got to give something. So you need to have consideration to an employee if they're going to enter an agreement, or if you're going to get services back from them. And an offer of continued employment is not sufficient, and specific tangible considerations required. It's always best to enter these agreements once employment is started, because there's a lot of common law requirements and case law that dictates how long an employee works for, and what their payout will be, and what their notice period will be. So it's always kind of best when dealing with employment to structure your employment agreements right when you get the person in your company, and not sort of wait, for a couple of years to go by, or things of that sort, because it will be more difficult to prove what the notice period is, and how long that employee was actually servicing the company. So the mandatory considerations when drafting employment contracts are, the clauses detailing the compensation, and what the employee will get upon termination, and what restrictive covenants, if any. I've sort of put a question there. Because they're not always required. So the common restrictive covenants are confidentiality, non-competition, and non-solicitation. So and the common law recognizes a duty to forever protect and maintain the confidential information of an employer. But the purpose of putting this clause in is to let the employee know of this obligation and to clearly define what is considered confidential information within a company and what it applies to. That's the key part of that provision. Non-competes and non-solicitation clauses. Basically, I know I'm running out of time, but the key point here is that they have to be reasonable. They can't, you will need an employment lawyer to sort of look over these, because there is quite a bit of case law on the subject of, what is deemed a restraint of trade, because you can't really take away someone's livelihood just because they've worked with you in their employment contract. And for example, so if we're talking a tech company and there's a developer, you can't sort of restrict the developer from ever developing or writing any code for another company, for the next 5 years or something like that. That probably would be considered a restraint of trade. So the key takeaway on employment contracts is that it's not one size fits all, and it needs to be sort of tailored to the position, and they're kind of a working document. So it's good to have a form. What I sort of recommend here is to seek some advice from a lawyer and get a form of an employment contract, and then tailor it based on the type of employee or the position or whatever that dictates. And that would probably be an efficient way, a cost-efficient way of doing it. So exploiting your patents. So this is sort of goes back to the main point on how you can drive value in your business from a legal perspective. And patents are assets that can be sold, and so can pending applications and patent. And it's also sometimes what this does is allows the company to show an investor that they do have done their necessary due diligence and sort of put in the time to ensure that there are no other patents existing, and that does show value to investors. Some investors might insist that you conduct patent filings before they invest in the business, and while others may not. But that's also, that also does improve your evaluation if you have that in place. And also, it deprives your competitors of using, the key technologies that might help them sort of compete with your business. So that also increases your value. So just basic questions on what potential investors might want to know about your IP, and you should sort of develop a framework around this and have an IP strategy in mind if you haven't thought about these questions. I think this is an important subject, and it seems to come up a lot in cocktail parties and things like that. People that I sort of speak to was who owns the IP is really important, and actually the person who develops the IP in your company, barring any sort of legal agreement between you and your employee, they own that IP, not the company. So unless you have an agreement in place that says that if it's an independent contractor, that they assign that IP back to the company, that would be one way to do it. Or in an employee contract, that would be a term of the employee contract, that whatever technology or work that's done while employed by the company, that IP belongs to the company. So that's a really important agreement that should be in place when hiring key staff. Of files that I've worked on where this has sort of been an issue and someone's left the company and they said that they own the IP, and there's often been settlements around it. So the key takeaways here to develop a best practices culture at your company, and seek the value, seek the experience of advisors, so lawyers, accountants, bankers, even other people in startups, and to help you sort of develop, these strategies. And it's really easy because when you're working in a startup, you're focused on the business and you want to grow the business, so it's really easy to forget about these things. And a lot of my friends and colleagues are involved in startups themselves, and so I can see how you probably, it is not the first thing you're thinking about is whether you have your due diligence set up for your tax strategy or IP strategy, but it's important to do it sort of early, because if you don't, it might be too late by the time you actually do think about it. And so, these issues won't come up in the beginning, and you can't really sort of push them under the carpet, because they do, investors, acquirers, they'll do extensive amounts of due diligence on your business, and it'll come up, and then when it comes up, it'll either result in a deal not going through, or a significant devaluation because some small employee contract wasn't done correctly, and it's really important to sort of set all of that up from the beginning. And the key thing is, the easy way to do it is get a lawyer to develop certain agreements that you can reuse as foundation agreements, and then also your shareholders agreement, that sort of stuff should be in place. But I mean, your employment contracts, your customer contracts, and that sort of things. It's kind of nice when you have a form that's the same and you can reuse it, and it's easier from a due diligence perspective too, when an investor comes in knowing that your company is very organized. Also take minutes of your board meetings, because it would be good to provide that to investors as well, so they know the decision-making process, what factors the management team consider, whether the management team has significant experience in certain areas. It'll all show in the minutes of your board meetings. Also, you want to have an IP strategy, and I know we didn't talk about tax, but it's really, tax is an area that you want to start thinking about earlier on and sort of develop a strategy around that. And there's plenty of tax specialists and also a lot of tax lawyers that can develop a strategy going forward and for the company, which can be employed in the startup stage. I don't know if you have any questions.
Yeah. Any questions?
In Ontario, if let's say a company wants to go for private placement,
Right.
is there any restriction on number of investors they can have?
So typically it depends on which exemption is relied upon, but on the accredited investor, there would be no restriction on that number.
Yeah, I have a technical question. I don't know if you can answer that. It's cool if you can.
Sure.
But so 45106 has a close personal friend exemption,
Right.
and the companion policy sort of has an interpretation on that, but that's also really vague. So do you know of any sort of hard and fast cases, either OSC decisions or whatever, where people have been knocked down for a close personal friend that wasn't actually that close?
I don't have a specific example in mind right now. I can't think of anything off the top of my head, but I could probably send you something after the fact, after this presentation.
Sure.
Yeah.
Could you explain a little bit more about the requirements of, let's say, an owner-operator with an invention that has kept the patent in his personal name when the operating company needs it to grow? What are the details in terms of, you said it can be assigned, but then you said the patent has to reside within the company. So I'm not sure, could you explain more about
So
that?
the patent would have already been filed?
Yes.
Okay, so if the patent has already been filed, then it's the person who's filed that patent is the owner of that patent. So if it's not the company, it would have to be assigned to the company. So if it was an employee or someone in the management team, perhaps, that filed the patent, that patent would have to be assigned to the company. So there would have to be a transfer, because it's an ownership
process? Is that cumbersome, costly?
I'm not too familiar on that process, but I think it would be a straightforward transaction for that ownership, right? But I'm not an IP expert, but I don't see that being a cumbersome process.
One last question here.
Sure, if we get the chance to sit down, we as entrepreneurs sit down with particularly shrewd, savvy angel or venture capitalists like Derek over here, is there one or two clauses, maybe one even, that we should really look out for in the early term sheets that might impact us at the end of the line? You talked about it a bit earlier. There's a lot of different things they could do to us, but is there one that you think is the most common that would hurt the entrepreneur when it comes time for an exit? Or at least that the entrepreneur should be particularly weary of if there's just one?
I mean, I think a lot of entrepreneurs are concerned about the control aspect of the business. But I think, when a VC or an angel comes in, they're also looking for liquidation themselves. So they're going to, ensure that that sort of, that aspect of it is avoided. So there wouldn't be any sort of liquidation bombs, as I sort of described, put into a term sheet. But I think from a shareholder's perspective or a start perspective, you do want to see that valuation would be the key term, and also control of the company. You might want, to put on management team or insert a new board, and that's sort of something that you would have to negotiate. So that's sort of what I would look out for would be that, and then I guess what sort of valuation they're giving you depending on the type of deal. If it's convertible debt, or I know that's pretty popular among startups, or if it's Series A, there's different sort of things to think about and that you can negotiate, and that also affects the price as well. Those legal terms that are put into a deal would affect the price.
That's interesting.
Yeah.
I didn't know that. Thank you.
So.
Thank you, Samir.
Thank you, guys.
Thank you so much.